Ladies and gentlemen, good day and welcome to Indiqube Spaces Limited Q2 and H1 FY'26 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need any assistance during the conference call, you may signal an operator by pressing star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Khanna from Ambit Capital. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of Ambit Capital, I would like to welcome you all to the Q2 and H1 FY'26 earnings conference call for Indiqube Spaces Limited. From the management today, we have with us Mr. Rishi Das, Chairman and CEO, Ms. Meghna Agarwal, COO, Mr. Pawan Jain, CFO, Mr. Vikas Agrawal, Head Investor Relations, and Mr. Vamsi Chatrati, AVP Marketing. We would like to now begin the call with opening remarks from the management, post which we will have the forum open for an interactive Q&A session. Thank you, and over to you, Rishi and Meghna.
Yeah. Thank you, Karan. Good afternoon, everyone, and thank you for joining Indiqube Spaces Limited Q2 FY'26 earnings call. On behalf of the entire management team, I extend a warm welcome to all our shareholders, analysts, and participants joining us today. We have uploaded our earnings presentation on the stock exchanges and our website, and I hope you had the chance to review it. This quarter marks another important milestone in Indiqube's journey. When we began, our vision was to decouple real estate from services and create a workspace as a service solution that enables ease of doing business, enhance employee experience, and deliver operational efficiency. Today, that same vision continues to guide us as we scale across India. The second quarter has laid a strong foundation for the rest of the year with strong financial performance and operational momentum. Importantly, our cash flows from operation exceeded EBITDA, underscoring healthy profitability and operational efficiency. Cash flow from operations more than doubled to 151 crores compared to 64 crores in the same period last year. Value-added services, VAS, remains an integral part of our business model. Their contribution increased from 11% to 13%, reflecting strong client adoption and higher engagement from both within and outside Indiqube buildings. We expect this momentum to continue as more enterprise clients integrate VAS into their overall workspace experience. Sustainability continues to be the core pillar of our long-term strategy. Building on our existing 20 megawatt solar farm in Yadgir, Karnataka, which has the potential to be scaled up to 70 megawatt, along with 22 rooftop solar installations across our centers, we are now expanding our solar energy capabilities to capture new adjacencies and reinforce our ESG credentials. This initiative not only strengthens our commitment to green energy, but also creates new business opportunities within the renewable ecosystem. Starting with our IGAP equivalent numbers, revenue stood at 54 crores for Q2 FY'26, representing a 38% year-on-year growth. EBITDA is at 75 crores, which is up 74% year-on-year. PAT margins improved to 8%, a considerable increase from 3% in the same period last year. Out of the total 9.14 million square feet of area under management across 125 centers and 16 cities, 5.8 million square feet is rent yielding area, and this provides a headroom of about 3.34 million square feet, roughly 75,000 additional seats, and these are expected to be operational anywhere between 18 and 24 months. Our strong financial performance, together with our CRISIL A+ stable rating, recently affirmed, underscores the resilience of our business model, our disciplined growth approach, and our long-term enterprise partnerships. With that, I will now hand over to my co-founder Meghna Agarwal to take you through the innovation and operational highlights for the quarter. Yeah, Meghna.
Yeah. Thank you, Rishi, and thank you, Karan. I'd like to begin by emphasizing that tech continues to remain at the core of our client experience. This quarter, we've introduced two major tech innovations. One is the air routing for transport management. Our automatic routing AI agent generates the most time and cost-efficient transport routes for employees, ensuring maximum ROI and smooth daily operation. And the second one is cafeteria crowd meter module. This tool leverages geospatial data and real-time order inflows to map the crowd density, and thus helping the employees to plan their meal times, thereby reducing the queue congestion, enhancing their productivity and satisfaction. We also plan, looking in the coming quarters, we also plan to roll out our space management module, which is giving flexibility to clients to configure their workspace and enhance their space utilization. While Rishi has walked you through our financial performance, let me touch upon the operational highlights for the quarter. This quarter, we have achieved significant milestones. We have signed a 1.4 lakh square feet workspace lease in Bangalore with the world's largest asset manager. We also secured a 68,000 square feet of design and build project in Hyderabad for one of India's largest automakers. We now serve 800 plus clients, comprising a balanced mix of 40% GCCs and 60% of Indian enterprise. Our focus on large, long-stay enterprise clients remains strong. Clients occupying over 300 seats now account for 65% of our total occupancy. Our monthly churn remains at just 0.021%, one of the lowest in the industry, reflecting a high client stickiness and repeat business. Occupancy level continues to remain robust. It stands at about 87%, up from 81% in the previous quarter. At a corporate level, our portfolio occupancy typically remains in the range of 80 to 85%, while our steady-state centers, which are operational over 12 months, maintain an occupancy of about 85 to 90%. And at this, we remain deeply confident about the road ahead, supported by strong client demand, a resilient business model, and an unwavering focus on profitability, sustainability, and innovation. With that, we look forward to addressing your questions during the question and answers session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Adhidev from ICICI Securities. Please go ahead.
Yeah, good afternoon, everyone. Thank you for the opportunity. So my first question is just to understand this Hyderabad, this design build we have signed up. Could you explain how different it is from the conventional managed office contracts that we have been doing? That is the first question.
Okay, so Adhidev, let me answer the first question. So the difference is, here we have three models in our business. We have one is the grow model, which is like a plug and play where the clients come to our buildings, and then take the entire services. But then we also have a model called bespoke, in which we do the design and build, in which the landlord deal is done by the client, but after that, anything to do with the design and the management, managing the entire facilities is done by Indiqube. So this design and build project comes under the bespoke model. And so the landlord deal was done by them, but the client really liked our product, our platform, and the way we have designed and managed the entire enterprise. So they signed up with us in the bespoke model.
Okay. So just to understand, would the margins differ in this sort of approach, or would it be similar to the existing offerings which we have? That was more where you're coming from.
Oh, no, so we have very healthy margins, and which is actually in the lines with the EBITDA margins. So there's no reducing of the margins here. It's absolutely healthy out here also in this model too.
Okay, fine. Yeah, the second question is, if you just help us understand the pipeline of properties in terms of sourcing from landlords which we have over the next 2 months, and where do we think our AUM will be here maybe 12 to 18 months from now, depending on how much visibility you have on your pipeline for space.
So we have written as in the presentation, which is also mentioned, Adidev, that our total signed portfolio currently stands as about 9.14 million square feet, which is approximately about 2 lakh seats, 2,03,000 seats. Out of which 5.8 million square feet is only the rent yielding area, which is about 1,28,000 seats. All right. So that itself gives us a headroom of about 3.34 million square feet. So in simpler terms, if I have to put it, my 9.14 million square feet will be converted into a rent paying area in about next 18 to 24 months. And this would translate almost like about CAGR of about 22%. So this is for the kind of, already we have a sign up which is in the kitty and in the pocket right now.
Okay.
And to add to that, as you see, we have added close to 1.3 million square feet. If you look at year on year, so we see that addition will continue on top of this 9.14 million, about 1.3 to 1.5 million per square additional AUM addition will continue to happen. Yeah.
Okay. Sure. I think that was more my question. And just as a bookkeeping question, by March 26, where do you think the operational area we will be exiting at by March 26 this year compared to the 5.7 we are at currently?
Yeah. So my rent paying area, I can give it to you. It will be around about 7.67 million square feet. That would be my rent paying area by March 26.
Okay. So that is quite an ramp up we're expecting.
Yes.
Okay.
Yeah.
Fine. Yeah. That's it from my side. I'll come back in the future more. Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1. Next question is from Shamit from Ambit Capital. Please go ahead.
Hi Rishi and Meghna. Congrats on a good set of numbers. So a couple of questions from my side. I wanted to know that you command around 20% market share in Bangalore and Chennai, while your presence is quite limited in other fast growing tier 1 cities like Mumbai and Pune. So how are you looking at these markets, and do you have plans to scale up in these markets? And secondly, in the first quarter, your portfolio level cash EBIT margins and occupancy was around 17% and 85%. In this quarter, you have ramped up the occupancy to around 87%, but the margins have, slightly remained flat despite the higher occupancy levels. So what factors are likely to influence the margin performance going forward? And lastly, if you could give any sort of guidance in terms of revenue, seat additions, and cash EBIT margins for 26 and 27, that would be quite helpful.
Yeah. So thank you, Shamik. So let me answer the second part of your question first. So as you rightly highlighted, there is a slight EBITDA improvement with quarter one, and we are at about 21%. What happens in our business is EBITDA margin, the exact EBITDA margin is also a function of the properties that we have added during the quarter. Now, suppose a large property gets added, definitely there will be a slight margin blip. I think, but the better way to look would be if you were to compare our year-on-year EBITDA margin. Like last year, this was about 17 to 18%. Now we are at 21%. So this 3 percentage point improvement that you are seeing has happened because the salaries as a percentage of the revenue have come down by about 1% odd. Then we have commissioned the solar power plant that we talked about, 20 megawatt and rooftop. So we have a substantial saving on the power bills. That has given us about 1 percentage point. And another percentage point has come in broadly because the way our rentals, the per seat revenue increases from our clients and our rental inflation with our landlords, there is almost a 1 percentage point delta over there. So that broadly, basically, it talks about the margin expansion. I will say that our margin will be pretty much range bound. In the 20-21%, it will hover around that number. I don't see that increasing very, very substantially, neither going down. There will be some fluctuation depending upon, as I said, that if larger properties get added or deals suddenly start giving revenue during that quarter. Now, answering the first part of your question, you are right in highlighting that Bangalore is a large part. Just 1 minute. I will share the data with you. Yeah. So basically, if you look at people talk about Bangalore, but Bangalore continues to be the largest commercial real estate market, consistently absorbing 20 to 25% of the country's total office demand. In fact, according to multiple reports, if you see, Bangalore absorbs more commercial real estate than Shanghai or even New York, positioning it as among the largest office markets globally. So it's like saying that we are the largest in the largest market globally. Also, if you look at more than 50% of the India's total office absorption is happening in South India, and this is led by Bangalore, Chennai, and Hyderabad. And the southern markets also record the lowest vacancy levels, typically in single digits, owing to deep talent pools, strong infrastructure, lower cost of living, and higher overall quality of life. So we follow these parameters while expanding, since 90% of the properties are taken proactively. That said, while South India remains our core growth engine, we are steadily expanding across other key metros as well. So if you look at our footprint in Mumbai, has grown from 85,000 square feet to now 140,000 square feet. We continue to expand Gurgaon, Calcutta, and other northern cities. We have added 3 cities in the last 1 year, Indore being the latest addition. We are seeing at least 3 to 4 more city additions happening in H2. So overall, there is an effort to be pan-India. We are following the strategy of follow the talent. So wherever our customers are expecting us to go, or wherever talent is going, we are going into those locations. And so that's how, Shamik, we see our pan-India footprint expansion.
Understood. And in terms of occupancies, is this current number of 87% sustainable going forward?
So occupancy, we see that if you look at, there are 2 occupancy data that we maintain. One is at the overall occupancy level, so that has ranged between 80 and 85%, and then there's a steady state center occupancy which hovers between 85 and 90%. So this 87% that you are seeing over the next 2-3 quarters, we see that this will be 85 plus minus maybe a couple of percentage points. Now, it depends upon, again, as I will go back to the point that if suppose a very large supply addition happens, you might see a 1.5% basically occupancy dip. But we are committed to maintaining occupancy in the mid-80s, and that's where we see that we are comfortably placed.
Understood. Thank you. And your my last question, like regarding your guidance in terms of revenue and seat additions, what would that be for 26 and 27?
So as Shamik, I've mentioned earlier also that we already signed 9.14, and this would become operational only in the next 2 years. And this would translate to almost like the top line growth to about 30% in the, for the next 2 years. And this has already been area which is signed, and it's in the different stages of construction or stages of phases where we are going to take it. So rent paying area is going to increase gradually in the next 2 years.
Thanks.
Thank you very much. Ladies and gentlemen, in order to ensure the management can address all your questions, I request you to please limit your question to 2 questions per participant. Next question is from Girish Chaudhary from Avendus Sparks. Please go ahead.
Yeah, hi. Thanks for the opportunity. Firstly, on the capex, how should we see the capex going ahead for the rest of the year and also next fiscal? Just as a follow-up, I see you have already spent close to 180 crores in the first half, right? And if I see your seat count has increased by 15,500 odd. So if I do a simple math, that translates to a 2,500 rupees per square feet of capex. I mean, what's the change there? Because generally you guide for 1,500 rupees per square feet, right? A seat.
Yeah. Thank you, Girish. So, the capex, as you rightly said, it is about 179 crores. And the difference between your net seat additions and the capex, you're seeing depends on the timing and the nature of investment made. So for example, operating cash flow, your 179 crore capex also includes advances for the future signed projects. It includes settlement of the prior period pending invoices, investments in interior fit outs, which is executed under the financial leasing, like the 60,000 square feet which you're talking about. You will not see the area additions, and the capital expenditure towards the solar installations also. Also, there could be a certain locations where my fit-out work must have commenced, but during the rent-free period. So if you see, because of all these differences, you would see a natural mismatch of the given period. You would see that net area additions will not reflect the capex because of all those reasons which I'm talking about.
Okay. So in that case, for the remainder of, let's say, 6 months, can we see a lower capex so that the timing mismatch again aligns back?
Yeah, so you will definitely see the gap reducing for sure, but some kind of a misalignment would always be there, as I said, because there would be a future projects which you would have signed, which you would have released advances. There would be certain other, other capex, which probably for the prior or the past. So all those mismatch a little bit would definitely be there, but the gap would surely keep reducing over the period of quarters.
Okay. So what's your budget for the year, fiscal 26 and fiscal 27 capex?
Capex, look, so in fact, if you ask us, like our capex is like about 15-17 per square feet, right? So in terms of area addition, that would be there, but my cash outflow or whatever the capex probably you would see would be different. That's what we're talking about.
Yeah.
So so I think this time is about 179 crores, something equal. We are expecting in the next H2 also.
Okay.
Similar range.
So around 350-360 crores for the year.
Something, some kind of we can say that something in the similar range.
Okay, and the following year, next year, because like you said, you have already signed up close to 9 or in the process of signing up 9.14 of AUM, right? So you'll be spending for that also next year.
So it will not be like completely next year. This would become rent paying area in 18 to 24 months. So there would be gradual, I would say, spend in the capex. Yeah, and I mean, whatever we've done the budgeting, I think it should remain in the similar range even for the next year also, whatever we have in FY'26.
Got it. Secondly, on the VAS, the value-added service, which like we have seen an increase from 11 to 13%. So just wanted to understand in terms of what's the runway here. One is if you look at the penetration within the current portfolio, how are you seeing trends in terms of people or tenants using the services, and where can this 13% go in the next 1 to 2 or 3 years?
So if you see, as you rightly put it, like value-added services contributes about 13% of the total revenue, which is up from the 11%. And as Rishi mentioned, that VAS remains an integral part of our business model, and there would be a steady increase, and this reflects the client adoption engagement. Looking ahead, our focus is on definitely broadening both our B2B and B2C service spectrum. This includes areas such as your facilities, F&Bs, IT, mobility, concierge, solar, and other enhancing services which we'll be getting into it. These value-added, we see that contribution increasing from 13 to at least 15% in the next financial year. So that is what we are, planning for and budgeted for.
Got it. Yeah. Thank you, and all the very best.
Yeah. Thank you.
Thank you.
Thank you. Next question is from Ayush Sabu from Choice Institutional Equities. Please go ahead.
Hi. Congratulations on a good set of numbers. Can you just elaborate a little bit more on the hub and spoke model, regarding how we are operating in that? Just throw more light on that.
Yeah. Thank you, Sabu. Our strategy, as I mentioned, has been follow the talent. So if you look at, say, locations like Koramangala or any CBD location like MG Road or Gindi in Chennai, most of these places, there is a dearth of larger buildings. So our philosophy is to take up smaller buildings and also have a larger campus. Then the larger campus actually acts like a hub, and then you have a lot of spokes. So it allows us to have much more amenities in the hub campus. Plus, what also happens is that think about Koramangala, we have clients which are typical, very young startups. Now, they may not be able to afford a very high quality or a very swanky center. So in our spoke locations, we are able to accommodate such clients. But if we have a GCC kind of client looking at a very premium space, then our hub centers are able to provide such spaces. And that is the strategy which we are seeing, that in micro markets which are mature and dense micro markets, that has worked well. So similarly on Outer Ring Road here, I talked about Gindi, or even Pune in the Yerwada location, or Baner location is where we see that we are slowly but surely narrowing down on creating more of hub and spoke models over there.
Okay, so like what is the ratio that we see going forward? Like how much should be under the larger format hub and how much should be in spoke models within the next couple of years?
Yeah. So today, if you look at, I will say about 50% of our properties are more than 100,000 square feet, like out of 125 operational centers, and about a similar number are less than 100,000 square feet. Now, if I have to further narrow down, about 1/3 of our centers are more than 200,000 square feet. So that is the broad mix. To give you idea, I see that definitely the average size of center, if I were to look at over the last 2-3 years, has been expanding. Like if our average was about 40,000-50,000 square feet 3 years back, now today that average is about 70,000 square feet or 75,000 square feet. So clearly the trend is towards larger centers, but at the same time, to maintain our presence and depth in the markets and be able to offer different price points, we also see that spokes will continue to be an integral part of our strategy.
Okay, yeah. Thank you very much.
Thank you.
Thank you very much. Next question is from Sumit Kumar from JM Financial Institution. Please go ahead.
Hi, good afternoon, and congratulations on a good set of numbers. My first question is on revenue growth versus area growth. The area occupied grew by 24%, and the revenue grew by about 38%. So what explains that difference? Is it the per seat pricing that has gone up, or there is a change in sort of a revenue mix or product mix?
Yeah. So, 2-3 things have basically factored in. One is the escalations that we have. That's the easiest one, because we have an annual escalation in our client contracts, whereas most of our landlords are on a 3-year escalation, like more like 14-15% every 36 months, where client escalations are annually between 5-6%. So that is one factor. Second factor has been the value-added services. If you see, which doesn't get reflected necessarily in the area, from 11% it has become 13%. So that is the other factor. Then if you look at like a lot of renovated buildings that we have picked up. Now in our renovated buildings, our margins are better. If our center level EBITDA is about 32%, in a new kind of a building, in renovated building this is about 40%. So that's a mix. We have been able to add some good renovated buildings, that is adding to it, and then the design and build projects that we are doing, because again that area is not reflected in the addition over there. So a combination of these factors is what is basically leading to this divergence, a positive divergence. Yeah.
Sure. My second question will be on the tier 2 expansion. You've added Indore and then Mohali, Kolkata. So the nature of the business remains same? Is it managed office or there is an element of co-working there?
It pretty much remains the same, I will say. Of course, the size of buildings that we are picking up in these locations is not as big as what we are doing in the tier 1s. But the mix of customer is very, very encouraging. I will say again, the GCCs are the bulk of the occupiers in a lot of tier 2 cities. In fact, a good percentage of our growth in tier 2 is actually being pushed on us by our existing clients, where they are expecting us to grow over there. And to give you another metric, if you see 40% of the area that is occupied is by clients who have taken space in more than one center. So that is a very healthy trend. The customer came to us in, say, a tier 1 city and liked us, and then they have expanded in the tier 2. But if I have to talk about the more mature tier 2 cities like Coimbatore, where we essentially started with one building of 75,000 square feet. Now we have a property which is 150,000 square feet, and we have signed up another property of 100,000 square feet. So definitely it's like firing bullets, and wherever it is hitting the target, go with cannonballs. So clearly there is a tendency to pick up larger buildings in those places as we understand the city better and as we have more confidence in that city.
Sure. So just one last question from my side. The movement from active stock, which is about 7.6 million, to 9.2 million, which is the area under management, you said it should take about 2 years. So just wanted to understand, is that because there are some properties which are under construction? Otherwise, fitting it out and then leasing it out should not take 2 years. So what's the sort of reason for that?
So you are spot on. A large part of these properties are like build-to-suit properties, where the lead time typically is 18 to say 30 months over there. So most of the properties that we are talking in the 18 to 24 month horizon are all build-to-suit.
Okay. So just one bookkeeping question. The nature of the difference between EBITDA and cash EBIT has largely remained the same, or is there anything else that you would like to highlight?
No. So the thing is, the difference between the EBITDA and the cash EBIT would be because of these pre-operating expenses which we do. We do the rental capitalization, which is what from 45 to 60 days. But in future years, you would see the gap reducing because we have kind of done the capping for 60 days. So as the portfolio would increase, you would see the gap reducing, but the difference is because of these pre-operating expenses of these rental payments for the first 2 months.
Okay, sure. That's all from my side. Thank you and all the best.
Thank you. Next question is from Janvi Shah from Share India. Please go ahead.
Hello, hi. Congratulations on the good set of numbers. And the questions that I had, I actually wanted you to share some light on the industry per se. Like you have multiple seeds that you're going to put out in the next 2 years. You have a pipeline for that. But do you see any slowdown in the demand perspective, or are we optimistic on the same? And which cities do we see more demand in?
Yeah. Thank you. So if you look at, just to give you some macro data, I mentioned that earlier that for the 9-month period ending September 2025, the gross absorption of real estate in India is about 60 million square feet. And within the last quarter, this number was 20 million square feet. So this is a record all-time high absorption of real estate in India. And out of this, 21% of the office space absorption has been done by the flex operators. So flex has become a very, very substantial part. 40% of this space has been occupied by global capability centers. So there is quite a upbeat demand. Most of the Indian cities today are running they are running at very low vacancy levels. So because supply addition has not been as steep as the demand. So that's the macro. Having said that, the GCCs are contributing a very large part. But if you look at the mid-cap IT companies and the non-IT Indian companies like our old school typical manufacturing or pharma, FMCG retail, they are also occupying a lot of space. Plus the startups are occupying a lot of space. So today the absorption is quite diverse from that perspective. So we are not seeing any slowdown as such. Of course, there is a question, or the big elephant in the room is that the rise of AI and all that. Will we see that some impact may happen because of that? But I must say that our industry from the rise of AI is actually coming in as a handy thing. And I will explain that why we are saying that, because it's a question which all of us have. Is if you look at when people come to us, why they approach a model like flex office spaces. See, for startups, it's primarily a cash flow and agility consideration. They are in hyper growth phase and they prefer to deploy capital towards their core business rather than locking that into long-term real estate. But if you go on to the enterprises and GCC, their driver is different. They aspire for grade A office spaces. They try to go to the larger tech parks. But as you know, most of the larger tech parks have larger floor plates. They are controlled by large REITs. They prefer to give the entire floor and they want the fixed commitments. So this limits the flexibility in terms of size, cost, and customization. So what our industry and Indiqube in particular brings is that this gap basically between what the larger operators are offering and enterprises and GCCs are looking for, we are able to provide a ready, managed, scalable solution that fits in. And last but the most important is that our industry has been delivering a 20-25% cost saving compared to conventional office spaces. And this comes because of economies of scale, the wholesale to retail cost advantages, and shared services efficiency that we pass on to our clients. Now, this emergence of AI driven efficiencies and periodic workspace structuring, companies are becoming more cautious and seeking agility and flexibility in their real estate strategies. If you look at one of the recent CBRE reports, it very clearly says that for most of the large occupiers, the question is not flex versus traditional leasing. The question they are asking is how much percentage of my space should be flexed. So rather than reducing demand, if you ask me, the uncertainty is actually accelerating the adoption of flexible workspaces, and that's reflecting in the increased share of the total commercial real estate absorption.
Thank you so much. So just like one last question. It is again on an industry basis only. Since this entire flex market is doing really well, a lot of players got listed, and I'm seeing the rise of more, like there are too many new entrants in the same industry right now, because I think there is a very low entry barrier. And everyone is scaling up really fast. Everyone is adding up seats really fast. Everyone has almost 30,000-40,000 of seats within the first year itself. So I'm just thinking, like, how do we see us competing against them, because they are in a growth phase and they are providing services at a very cheaper cost. So how are we placed against them?
Yeah, so I will go back to looking at the way the traditional commercial office spaces are. Today you look at, for example, Bangalore or Mumbai, Pune, NCR, you will see there are 2-3 developers which are absolutely dominant, right? And yes, to be very honest with you, yeah, so that is exactly how the managed office industry is evolving. For example, we talked about Bangalore. Now in Bangalore, we have more than 20% market share of the entire press industry. So what happens is that there are a lot of network effects coming in. For example, suppose if I am a large occupier looking for office space, I would like to go with an operator who typically can continue to support in my growth. I don't want one operator for one building, another operator for another building, or I don't want discontinuity. So larger operators, whosoever are there in any given city, that is a big moat in this business. So in how many cities people are present and how dominant they are in a given city, I think will be a very, very important metric, which will build barriers. Second thing is, if you see, GCCs are the biggest occupiers, and as Meghna mentioned, that people who have taken more than 300 seats constitute 65%. So this essentially is an enterprise business. Now, if you are a large enterprise, whenever you will float an RFP, typically you will like big five to participate. You don't open the RFP to 20, 30 participants for any service or any product. I think, and that is what this industry is gravitating towards. There will be 4 or 5 large players, say in excess of 5 million square feet, pan-India presence, offering the entire spectrum. And then you will have one city players who might be very dominant in one city kind of a thing. And then the whole complexity around the value-added services. Again, now I will go back to my hotel example. If you look at, like today, anybody can open a hotel, but over a period of time, if there is a brand like a Taj or Oberoi or a Leela, you see the difference in the quality of service. So surely in our industry, the quality of service, the SLAs, the dependability, all this are catching up. And that is the reason when I said that 40% of the space is occupied by clients who have taken multiple centers. So there is a big, strong referenceability network effect coming in. So a combination of all of this is playing out. And while you may not see a lot of smaller players having existential crisis, but we definitely see that the whole, at least the 50% or 60% of the market will gravitate towards the big 4 or 5 players. All these factors that I talked about will play out, and they are already playing out in our case. I gave you case in point Bangalore or Chennai or Coimbatore kind of locations where we have large dominance.
Thank you, sir. Thank you.
Thank you very much. Participants, in order to ensure the management can address all the questions, I would request you to limit it to 2 participants. Next question is from Mohit Agarwal from IIFL. Please go ahead.
Yeah, good afternoon and congratulations on good set of numbers. Most of my questions have been answered. Just couple of them. First, for the first half, you've reported a operating cash flow of 150 crores, and you have a capex of about 180 crores. With you broadly guiding about 30% revenue growth, fair to say that FY'27 is year when you turn free cash flow positive?
FY'27. Yeah, I mean, it will be break even or slightly positive, Mohit, definitely in FY'27. That's what we are seeing.
Okay. So thanks. So broadly, let's assume the capex would be in the 350 crore range for let's say 27 also, and then obviously the operating cash flows will improve, right? Is that the right way to look at it?
Yes, absolutely. That is exactly the right way to look at it.
Okay. My second question is, just try to think, as what could be the biggest probably challenges that you would face, and would one of them would be sourcing supply. When we track other REIT companies and commercial real estate companies, we see that the rental escalations in some of the certain cities like Hyderabad, Bangalore have been more than 5-7%. So how, if you could kind of take us through what has been the challenges if you're facing, if any, and do you think that could be a big differentiator of, now you have already a 9.2 million square feet, but, is the rental escalations, too high to pass on to your tenants, or has that not been a challenge? If you could kind of, take us through some of the challenges on the supply sourcing side, that would be nice.
Thank you. So as you rightly highlighted that from a short to medium run, we are sorted because of the 9.14 million supply that we have. Now, what we are currently focused on is looking at FY'28 and beyond kind of supplies. And there, we are looking at a combination of predominantly 2 kinds of supply. One is the build to suit, where we get into with landlords, and most of them non-institutional kind of landlords at the baking stage, at the land stage. Conceive the projects, help them through the whole process, and get a good quality purpose-built building. And we have seen that if we get early in the process, these buildings are 15 to 20% cheaper. So that will be the one big mainstay of our supply. Second, we are looking at renovated buildings. Now there we have a product called Cornerstone. Now through Cornerstone, what we are doing is we are looking at acquiring a lot of older assets, like a lot of brownfield that we have seen in airports happening. So India has almost 500 million square feet of real estate, which is more than 10 years old. And a very large percentage of that is non-institutional. So we are going and seeing that how we can offer asset management in those buildings and increase our footprint. And since we have already executed about 3 million square feet of renovated buildings, we are seeing a lot of first mover advantage. So a lot of our supply in the CBD, SBD will come through that route. And since these buildings are older buildings, they are coming at a fraction of the price of a new building coming up in that market. Like to give you an idea of Bangalore MG Road, if a new building today is getting signed up at $300, these buildings are coming at $130, $140. So there is a huge delta even after doing renovation and all that we see a good head start. And then of course we will pick up some supplies which are more reactive. Wherever a client says, okay, I want to get into this tech park and all that, we will go with a bag of money and pick up supplies over there. So it will be a combination of all the 3, and we always take a 3 to 5 year view when it looks at supply, because supply it cannot be solved in the short run in a cost effective manner. So that is the combination of all this is what Mohit has been our strategy, and in a high performing market like Bangalore, imagine which is the best performing market in the country. If we are today dominant, I think we have been dominant because of a mix of all that I just said.
That's great. So Rishi, just on your Bangalore example of 300 rupees rental getting at 130, 140. Typically, what would be the per square feet capex that you'll end up doing? And would you get, when you renovate the building, would you get a 2.5 time multiplier on the 300 rupees from the tenant?
Yeah. Yeah. So you are so right on that. Like, typically, the CapEx incurred on renovation is between 500 to 1,000 rupees per square feet. And this is done in a contributory manner with the landlord and us. And once we do the renovation, we are seeing that our per seat yield is easily improving by 20 to 30% improvement we are finding. And most of the payback in renovations are between 18 and 30 months. All our renovation paybacks have been of that magnitude. So, yeah.
Great. Perfect. Thanks a lot and all the best.
Thank you.
Thank you. Next question is from Mitul Thakkar from Astha. Please go ahead. Mr. Thakkar, your line has been unmuted. Please go ahead with your question.
My question is covered from the previous participant. Thank you.
Thank you. We will proceed to the next question from the line of Vipul Kumar from Narnonia Financial Services. Please go ahead.
Yeah, hi. Good afternoon. So, am I audible?
Yes.
Yeah. So my first question is, what is the current consumption trend of managed office spaces in terms of square feet, and what are the growth drivers of it? Basically, what is the outlook?
Yeah. So, if you look at, like, out of the 60 million square feet absorption that has happened in India this year in the 9-month period, 21% of that has happened by the flex industry. So at a year level, if you take 80 million square, so basically 16 to 20 million square feet of absorption is what basically the flex industry is doing. And today we are almost at 100 million square feet, kind of a total stock of flex office space in the country, likely to go up to 140 million in the next 2 years with an annual addition of about 20 million annually.
Okay, and what are the growth drivers for you?
So growth drivers are multiple. I will say, like some of that I talked about, like why people are coming to our industry. One big factor is work is going where people are rather than people going where work is. If you look at my generation, went where work was, but today work is going where people are. That's where you see a rise of a lot of tier 2 cities. That is one factor. Second factor is the whole hotelization or amenization of workspaces. People want everything in the office. It's like today when you buy the apartment, you don't buy the 4 walls. You pretty much buy the experience. So people want a very similar kind of thing in office spaces. That is a big driver over there. Then people want a lot of flexibility because like 3 years, 5 years down, how things will move. So variabilization is clearly what companies are looking at. So larger companies, if they have a 10 million portfolio, they want 2 million of their portfolio or 3 million of their portfolio to be in the flex model. That is driving the things. And then as I talked about that, as the city centers are seeing metro coming in, city centers are coming back to life. Most of the stock in city centers are very old buildings. So if one can come and renovate and offer a great experience, there is opportunity over there. And the whole, the physical infrastructure, the digital infrastructure, connectivity is so good in a lot of tier 2 cities that a lot of jobs are going over there. So the whole growth is getting democratized, and the average size of office is reducing. Like earlier, if you see, companies will have a big one fat campus. Now, instead of having one big fat campus, they will say, okay, I will have a hub, and then I will have spokes, maybe in the same city or in other cities. So distributed office concept is coming in. Then the whole application of technology. So all of these are basically the you can say the tailwinds that are helping the rise of the flex industry.
Okay, great. One more question regarding the self-sustainable growth. So could you provide us what is the self-sustainable growth rate for us?
So, as Meghna mentioned, if we were to look at whatever supply stock we have, all of that, I think we are quite hopeful that we should be able to sustain a 30% kind of a growth rate, 35%, maybe plus minus 2-3% here there. I think that kind of growth looks very doable to us over the next maybe 2 financial years for the sure.
Okay. And one more last question. What is our current capex per square feet and how it will be going ahead?
Our current capex is about 1,517 rupees per square feet at a portfolio level. And we see that there will be a 2, 3 or maybe 4% inflation year on year on these numbers.
Okay. Thank you. That's it from my side. Thank you.
Thank you.
Thank you.
Next question is from Raj from Feedent. Please go ahead.
Yeah, hi. My question was regarding the design and build segment. So what kind of order book currently we have in that segment? What is the, if you could share some revenue targets that you are targeting for the next 1 or 2 years? And in terms of our clients, so what percentage of our clients opt for design and build as well for them? So that was my first question.
So we have not divided in terms of numbers the design and build. So the way we put it is like in terms of the value-added services or in the financial leases. So as we said, the growth, we will be growing at close to about 30%. Now this will be a combination of both leasing, bespoke model, grow model, design and build. In the pipeline, I mean, we do have about close to almost like about close to about in like recent, like just next 2 quarters are about 1.5 to 2 lakh square feet of design and build in just like next 2 quarters. But as I said, it's the top line growth we cater to, and this all comes as a part of the growth. We have not divided it into how many clients and all. Yeah.
Okay. And any plans on doing manufacturing of furniture as well? I think a couple of peers are also looking at that thing.
No. So that is definitely not on the cards, because for us, actually, when it comes to furnitures or any design specifically, if you see, the design has been evolving quite fast. I mean, what we were doing probably just 6 months back, we're not doing it anymore. And the innovation which is happening in the materials, biophilia, and there's so many things, the manufacturing would be like sticking yourself, become rigid. And rigidity is definitely which we kind of get away with. Our idea is to work with the multiple OEMs, multiple designers and the manufacturers and bring them on our platform. And, so we kind of do some kind like a contract manufacturing, bring on the platform, give our own designs, but not to manufacture ourselves.
Okay. Yeah, and just one more question. So before if you venture into any new area or any new geography, so how do you decide on say a particular target market? How do you decide whether this would be this specific area would be a good area for a new center, whether it is based on a good availability of a grade or a grade asset, or it is more regarding whether the clients are situated in this area? So how do you decide on a new area?
So basically it is more, as I said, that we have a strategy of follow the talent. So wherever we see good concentration of talent, it's not a question of whether, it's just a question of when we are going to go there. And we may discuss different strategies to get in that market, but we pretty much have to get there. So I think talent is a key driver. Once we are clear that, okay, there is a lot of, for example, if you look at say cities like Bhubaneswar, we see that there is a big amount of diaspora. Right, a lot of Odia people, or you people see people from Northeast, there will be a lot of people who will be working in different parts of the world. So wherever we see that the diaspora is there and people will have a susceptibility to go back to their native places, I think those are clear shortlist. Then what we look at is, okay, getting a good quality asset. Let me tell you, while we are talking so much about tier 2, the quality supply in tier 2 is just not there. So a lot of times we end up signing a build to suit or under construction buildings, and all of that is where we have to work upon. So we look for the right supply in these locations, and then we try to see that if there is an anchor support for us. Basically, like if suppose one of our existing clients is keen to pick up some space, it gives us a lot of impetus in the beginning. So when it comes to tier 2 locations, that's the strategy. But when we talk about tier 1, definitely, like if you look at Bangalore has almost 15 micro markets, Bombay has about 10 micro markets. So we continuously keep looking for the micro markets where we are not present, and at a right time start in those micro markets. A lot of data in terms of competitive intensity, availability of office spaces, our clients' willingness to go there. All this is basically a continuous process. And for us, every property that we pick up is like investment. It can give us pain or pleasure for the next 15-20 years. So we are very careful whenever it comes to picking up assets, and we do a fair amount of due diligence. A scorecard is there. There is a committee that looks into any new property that is getting added before those decisions are made.
Got it. Okay. Thank you so much.
Thank you. As there are no further questions, I would like to hand over the conference to management for closing comments.
Thank you so much for all the time, and the questions were really very deep and insightful. And our intent was to keep our brief short and give as much opportunity to ask the questions. And I'm sure the analysts and the investors on the call, the shareholders are better informed about the company. And thank you so much, for all your time.
Thank you.
And thank you, Ambit. Thank you, Karan, for making this possible.
Thank you. Thank you for everything. Thank you,
and
everyone.
thank you, Valorum team, for making this happen. Anuj, thank you.
Thank you. On behalf of Ambit Capital, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.
Thank you.